Welcome, everyone. It's great to be with you today. In this lecture, we begin with a basic finance question. What should guide financial decision-making inside a firm? That sounds simple, but it is powerful. A firm constantly chooses, should it invest in a new product? Should it borrow money? Should it hire employees? Should it reduce costs? Should it enter a new market? Should it return cash to owners? Every decision affects more than one number. It can affect profits, cash flows, risk, employees, customers, creditors, suppliers, communities, and it can affect the future direction of the organization. So finance needs a clear objective. Without a clear objective, decisions become inconsistent. One manager may prefer growth, another may prefer safety, another may prefer short-term earnings, another may prefer social impact. These goals may overlap, but they must be evaluated inside a disciplined framework. Corporate finance often says managers should increase the value of the firm. That answer is useful, but it also raises important questions. What does value mean? Value for whom? Over what time horizon? And how should managers think about ethics and stakeholder consequences? Today, we will connect these ideas. Value creation, firm objectives, shareholder value, stakeholder value, short-term pressure, long-term value, and responsible judgment. By the end, you should see that finance is not only about numbers. Finance is about using numbers wisely. Let's begin. Let's start with value creation. A firm creates value when the benefits of a decision exceed the full economic cost of the resources used. In simple language, a decision creates value when it produces expected future cash flows worth more than the resources invested today. That definition is short, but it contains several important ideas. First, cash flows matter. Financial value depends on cash that can be generated, saved, reinvested, or distributed. Accounting earnings are useful, but earnings are not the same as cash flow. Second, timing matters. A dollar received today is more valuable than a dollar received years from now. Why? Because today's dollar can be invested. It can reduce debt. It can provide flexibility. Third, risk matters. A risky cash flow is less valuable than a safer cash flow with the same expected amount. Investors require compensation for bearing risk. Fourth, opportunity cost matters. Capital used for one decision cannot be used for another decision. A project may look attractive when viewed alone, but it may destroy value if it earns less than a comparable alternative. Fifth, scale and sustainability matter. A decision may create cash flow today, but damage future value. It may hurt customer trust, weaken employee morale, damage supplier relationships, create legal problems, and harm reputation. So value creation is not just making money today. It is creating cash flows that are strong, timely, risk-aware, and sustainable. Now let's look at the central valuation idea. In finance, we often say the value of a business is the present value of its expected future cash flows. That may sound mathematical, but the intuition is very practical. A firm is valuable because of the cash it is expected to produce in the future. Those future cash flows must be brought back to today's value. That process is called discounting. Why do we discount? Because cash received later is worth less than cash received now, and because risky cash flows are worth less than safer cash flows. In simplified language, firm value equals the sum of expected cash flows, each discounted by a required return. The required return reflects the risk of those cash flows. If expected cash flows rise, firm value tends to rise. If cash flows arrive sooner, firm value tends to rise. If risk falls, firm value tends to rise. If the required return rises, firm value tends to fall. This formula is not only a formula, it's a way of thinking like a financial manager. Managers create value by improving the amount of future cash flows. They create value by improving the timing of cash flows. They create value by reducing unnecessary risk. They create value by protecting the sustainability of cash flows. This is why finance looks forward. Past performance matters, but financial decisions are about the future. The key question is not what happened last quarter. The better question is, what future cash flows will this decision create? When will they arrive? How risky are they? And what alternatives are being given up? Now, we need to separate accounting profit from economic value. A firm can report accounting profit and still fail to create value. That may sound surprising, but it's very important. Accounting reports often summarize past performance. They follow accounting rules. They help investors, managers, and creditors understand what happened. But financial decisions are forward-looking. They depend on future cash flows, timing, risk, and opportunity cost. Accounting profit may include non-cash items. It may not fully reflect when cash actually arrives. It may not fully reflect risk. It may not charge for the opportunity cost of capital. It may be affected by accounting methods, and it may improve in the short run while long-term value declines. Imagine a firm trying to improve this year's earnings. It may cut research and development, reduce employee training, delay equipment maintenance, and lower product quality. These actions may make current expenses look lower. They may improve near-term accounting profit, but they may also damage future cash flows. They may increase risk, reduce competitiveness, and weaken trust. So the finance question is not simply, will this decision increase earnings this period? The better question is, will this decision increase the long-term value of the firm after considering cash flow, timing, risk, and alternatives? That's a much stronger question. It forces managers to look beyond the accounting number. It connects performance with economic reality, and it helps prevent short-term choices from damaging long-term value. Firms can pursue different objectives. Some objectives are financial, some are strategic, some reflect broader responsibilities. One common objective is profit maximization. This means increasing accounting profit or net income. Profit is important, but profit maximization can be incomplete. It may ignore timing, risk, how much capital is required, or long-term consequences. Another objective is sales growth or market share growth. This means increasing revenue, customers, or market presence. Growth can be valuable, but growth can also destroy value. If margins are weak or capital needs are excessive, more sales may not mean more value. Another objective is shareholder wealth maximization. This focuses on increasing the value of owners' claims on the firm. Properly understood, this is a long-term idea, but it can be misunderstood as a narrow focus on short-term stock price. Another objective is firm value maximization. This focuses on increasing the total value of the business to all capital providers. That includes both debt and equity. This objective requires careful measurement of cash flows, risk, and financing effects. Another objective is stakeholder value. This means creating durable value while considering owners, employees, customers, suppliers, creditors, communities, and others. This is important, but it can be difficult to measure. It may involve conflicts among groups. Another objective is survival and financial flexibility. A firm needs liquidity, resilience, and ability to continue operating, but excessive caution can also be costly. A firm may reject valuable opportunities because it is too conservative. The main point is this: objectives often overlap. A firm that treats customers well, invests in employees, manages risk, and uses capital wisely may also create value for owners. Conflict arises when objectives differ across time horizons, stakeholder groups, or measures of success. Now let's focus on shareholder value and firm value. In a corporation, shareholders own the firm's equity. They have a residual claim on the firm's cash flows. That means shareholders receive what remains after employees, suppliers, lenders, governments, and other contractual claimants are paid. Because they receive what remains, shareholders bear significant risk. The shareholder value perspective says managers should make decisions that increase the value of shareholders' ownership claims. But this idea must be understood carefully. It doesn't mean maximizing this period's profit. It doesn't mean ignoring customers, employees, suppliers, creditors, or communities. Shareholder value is a long-term concept. It is based on expected future cash flows and risk. A stock price can move for many short-term reasons. Market mood can change, and earnings pressure can affect expectations. But long-term value depends on the business itself, on customer trust, on employee capability, on supplier reliability, on responsible financing, on risk discipline, on capital discipline. Growth creates value only when the return on invested capital exceeds the required return for the risk taken. Firm value is related, but broader. Firm value refers to the value of the entire business. It is often viewed as the value of debt plus the value of equity. This matters because financial managers must consider all capital providers, not only shareholders. When shareholder value is misunderstood, it can encourage harmful behavior. Managers may cut necessary investment. They may take excessive risk. They may underinvest in people or quality. They may ignore legal, environmental, or reputational risks. They may use financial engineering to create the appearance of value. A stronger interpretation is durable value. Durable value depends on productive assets, competitive advantage, customer trust, efficient operations, responsible financing, and sound governance. Now let's discuss stakeholder value. A stakeholder is any person or group that can affect the firm or be affected by the firm's decisions. Stakeholders include owners, employees, customers, suppliers, creditors, regulators, and communities. Sometimes they include future customers and the natural environment. The stakeholder value perspective says firms should consider the effects of decisions on multiple groups, not only owners. This is especially important when a decision creates costs or risks that do not appear immediately in accounting reports. Stakeholder analysis does not mean every stakeholder receives everything it wants. Financial resources are limited. Trade-offs are unavoidable. Instead, stakeholder analysis helps managers identify who is affected. It helps identify what interests are at stake. It helps identify how those effects may influence long-term value and ethical responsibility. Owners provide equity capital, and they bear residual risk. Employees provide labor, skill, knowledge, and service quality. Customers provide revenue and market validation. Suppliers provide inputs, services, credit, and operating reliability. Creditors provide borrowed capital. They also monitor default risk. Communities provide infrastructure, labor markets, public services, and legitimacy. Regulators and governments define legal obligations and tax requirements. Each relationship has a financial connection and can create possible tension. Higher returns for owners may conflict with wages, benefits, or job security. Higher prices may improve margins but harm customer trust. Aggressive supplier pressure may weaken supply chains. Risky strategies may concern creditors. Expansion or closure may affect communities. Compliance costs may conflict with short-term profit goals. Still, stakeholder value and financial value often reinforce each other. Customer trust can improve future revenue. Skilled employees can improve quality and innovation. Reliable suppliers can reduce operating risk. Good compliance can reduce legal risk. So, stakeholder thinking is not separate from finance. It's part of understanding durable value. Many financial decisions involve stakeholder tensions. These tensions are not always obvious at the beginning. A spreadsheet may show revenue. It may show costs, taxes, investment outlays, and working capital. But broader effects may appear later. They may appear through turnover, customer complaints, litigation, reputation damage, regulation, higher financing costs, and strategic weakness. One tension is cost reduction versus employee welfare. Lower expenses may improve margins, but layoffs, benefit reductions, or unsafe workloads may reduce morale, productivity, and trust. Another tension is pricing power versus customer fairness. Higher prices may improve margins, but if customers see the increase as unfair, trust may decline. Another tension is supplier pressure versus supply chain resilience. Very low prices or slow payment may help the buyer today, but they may create quality problems or delivery risk later. Another tension is debt financing versus financial stability. Borrowing can increase returns to owners, but it can also increase default risk and reduce flexibility. Another tension is growth versus community impact. Expansion can create jobs and tax revenue, but it may also create local costs. Another tension is short-term earnings versus long-term investment. Reducing maintenance, research, training, or quality control may improve current results, but it can weaken future cash flows. The presence of tension does not automatically mean a decision should be rejected. It means the decision requires careful evaluation. Managers should ask whether benefits justify costs, whether risks are being shifted unfairly, whether affected groups are being treated responsibly, and whether the decision is sustainable. Ethics matters here. A decision may be financially attractive, but questionable in honesty, fairness, responsibility, or harm. Financial decisions allocate resources. They distribute risk. They affect people's lives. An ethical financial decision is not only a decision that avoids legal punishment, it is a decision that uses capital responsibly, communicates honestly, and considers real consequences. One of the most common tensions in financial management is short-term performance versus long-term value. Short-term measures are important. Quarterly earnings matter. Revenue growth matters. Operating margins matter. Cash balances matter. But these measures can be misleading if managers focus on them at the expense of future value. Short-term pressure can come from many places. It can come from owners, analysts, lenders, compensation plans, internal budgets, and competitors. This pressure can push managers toward decisions that look good immediately but become costly over time. A firm may delay maintenance to reduce current expenses, reduce customer service staffing to improve margins, cut research and development to meet earnings targets, offer excessive discounts to increase current sales, borrow heavily to fund distributions instead of investment, and accept unsafe levels of operating or financial risk. Long-term value requires a broader view. Managers must ask whether today's decision improves or weakens the firm's ability to generate future cash flows. A decision that lowers current profit may still create value. It may strengthen competitive position, reduce risk, improve trust, and build valuable capabilities. A practical decision framework can help. First, define the decision clearly. Second, identify which cash flows will change. Look at incremental revenues, costs, taxes, investment needs, and working capital effects. Third, ask when the cash flows will occur. Separate immediate effects from future effects. Fourth, evaluate risk. Consider operating risk, financing risk, competitive risk, legal risk, and reputation risk. Fifth, identify the capital required. Also, identify the alternatives being given up. Sixth, identify who is affected. Think about owners, employees, customers, suppliers, creditors, communities, and other relevant groups. Seventh, consider ethical concerns. Think about honesty, fairness, transparency, safety, compliance, and responsibility. Finally, ask whether the decision creates durable value. This framework does not remove the need for judgment. It makes judgment more disciplined. Financial management often requires balancing competing objectives. Not everything can be maximized at the same time. More growth may require more risk. More liquidity may reduce return. More debt may increase potential returns to owners, but also increase financial distress risk. Higher wages may increase costs, but improve retention and productivity. Lower prices may help customers, but reduce margins. A useful distinction is the difference between objectives and constraints. Objectives describe what the firm is trying to improve. Examples include firm value, customer loyalty, profitability, growth, innovation, and resilience. Constraints describe limits that must be respected. Examples include liquidity needs, debt capacity, legal requirements, ethical standards, safety requirements, and minimum service quality. This distinction matters. A firm should not maximize financial value by violating the law. It should not mislead investors. It should not endanger employees. It should not impose hidden costs on others. These are not simply spreadsheet variables. They are boundaries of responsible decision-making. Within those boundaries, managers should seek decisions that create the greatest sustainable value relative to the risks and resources involved. Good financial judgment requires numbers, but it also requires interpretation. It requires communication. It requires responsibility. Before approving a major decision, a manager should think carefully. What assumptions matter most? Who benefits if the decision succeeds? Who bears the cost if the decision fails? Are risks being accepted knowingly or ignored accidentally? Are we improving long-term cash flows or only short-term metrics? Are affected parties being treated honestly and responsibly? That is the real work of financial management. Thank you for joining me today. I'll see you at the next video.